All right. So we're going to be talking about the Black-Scholes model of pricing both corporate liabilities and options. So I'd like to just go ahead and start off by asking ourselves, what is the Black-Scholes model? According to the Economic Times, the Black-Scholes model is a pricing model used to determine the fair price or theoretical value for a call or put option based on 6 variables such as volatility, type of option, the underlying stock price, time, the strike price, and the risk-free rate. The quantum of speculation is more in case of stock market derivatives, and hence proper pricing of options eliminates the opportunity for any kind of arbitrage. So there's a lot in there. So let's first talk about what's a call option, what's a put option. A call option gives you the right but not the obligation to buy an underlying security. So if you were to buy, say, a call option for Apple, that would be the right but not the obligation to buy a share of Apple at a predetermined price or the exercise price sometime in the future. So, for example, if Apple was trading for $100, it's trading for more than that, but just for example's sake, let's say Apple is trading for $100. At $100, the stock price would go up or down. But if you bought a call, you are hoping that the stock price will go through the roof. Let's say the strike price is $125. You are hoping that the underlying asset is going to reach above $125 so that you can then purchase the stock for $125 and then turn around in the market and sell it for, let's say the underlying stock price of Apple is going up to $150. You can buy something worth $125 and sell it for $150. That's the idea behind a call option. Now, a put option is the right but not the obligation to sell an underlying asset. Generally, you would buy a put option if you believed that the price of the underlying security was going down. So let's use the same example. Let's say Apple. Let's say we think that Apple is going to go down and that we think that we can really profit off of that market downplay by buying a put option in Apple. By doing that, we're going to, let's say that the stock right now, or the strike price is $100. Again, we use the same numbers. Strike price is $100. We're going to say that we're thinking that Apple's going to be trading lower than $100 sometime in the near future. So let's say the exercise price or the strike price is $100. The underlying stock that moves to $50. Well, here's what that means. You're able to sell something worth $50 for $100. Therefore, you are profiting. So the Black-Scholes model is essentially a model that says, how can we best utilize a very meticulous mathematical equation to value different options and warrants. And we'll talk about what a warrant is here in a minute. But according to the Economic Times, the Black-Scholes model is largely used by option traders who buy options that are priced under the formula calculated value and sell options that are priced higher than the Black-Scholes calculated value. So this kind of goes into the idea of what an intrinsic value is, right? We want to buy things that are undervalued and sell things that are overvalued. So that's kind of the idea behind the Black-Scholes model. That's why we're using this. We're trying to say, what is the calculated price using the Black-Scholes model? Okay, is the asset of a call or a put, is it under or overvalued? Okay, so if it's overvalued, we're gonna buy a put option so we can sell it. If it's undervalued, we're gonna buy a call price so that we can buy it, right? Based on those exact same examples that we just talked about. So how does the model work? First, according to Black-Scholes, the actual formula or the actual article, there are several market within the formula or the formation of the formula. So number one, the short run interest rate is known and constant through time. So the short-term interest rate is going to be known. It's going to be constant through time so that we can actually use that to discount our cash flows back to today's dollars. Next, the stock price follows a random walk in continuous time with a variance rate proportional to the square of the stock price. Thus, the distribution of possible stock prices at the end of any finite interval is log normal. the variance rate of the return of the stock is constant. So that's just going to be the second thing that we're going to hold true within this model in order for it to work. Next, now normally there are all kinds of stocks out there, right? Like there's stocks that pay dividends, stocks that don't pay dividends, stocks that are going to have some kind of capital appreciation. Under the Black-Scholes model, we are going to say that a stock is not going to pay a dividend or any kind of distribution. Now, that's not to say it can't go up in price, but we're not going to pay a dividend, or we're not going to have a stock that pays dividend. Now, in reality, is that possible? Of course it's possible. There are plenty of stocks out there that you can buy options on that are going to have some kind of dividend paid out against it. Okay, next, the option is European style. That is, it can only be exercised at maturity. There are two types of option contracts that you can actually utilize. First, European, which we just talked about, it can only be exercised at maturity. Remember, we talked about the process of it being exercised at some point in time. Most options are going to be American style. And what that means is that American style, we are actually going to be able to exercise anytime prior to maturity, including maturity. So we're going to be able to exercise the option at any time prior to maturity, including maturity. So you can see there's a lot more flexibility with American style options as opposed to European style options, right? So we can kind of see the flexibility there, but Black-Scholes, the model that they have formulated has basically said we're going to stick with European because it's more predictable. We know when the maturity date is going to be. We can actually use that. Next, number 5, there are no transaction costs in buying or selling the stock or the option. Now, again, is that going to be plausible? Maybe, maybe not. But for the purpose of actually formulating this hypothesis, formulating this formula, we're going to say that there is no actual transaction cost associated with it. And then finally, there are no penalties to short selling. A seller who does not own a security will simply accept the price of the security from a buyer and will agree to settle with the buyer on some future date by paying him an amount equal to the price of the security on that date. So let's talk about selling short for a second. What does that mean? Selling short is going to be when we are essentially going to. So I've got. If you think about, normally I would have students in the room, but I'm going to point out a student. I've actually got my student worker here timing me right now. So I'm going to say, okay, I'm going to borrow your stock and I'm going to sell it in the open market. Okay. The only thing I owe my student worker is actually giving him that stock back. Just imagine it like a stock certificate, like a piece of paper. I've got to give that back to him at some point. So short selling is going to be where I borrow that stock, I sell it in the short market because I think the price is going to go down, right? So I owe, let's use Apple again. Let's say Apple is $100, right? So I'm going to borrow that stock that's worth $100. I'm going to sell it for $100. I'm going to wait till the price goes down to say 50. Then I'm going to buy it back and give it back to my student worker. Okay. What's the profit I just made in short selling? I just made a $50 profit right there. So let's talk about some of the inputs that the Black-Scholes model is actually going to use. According to Khan Academy, the formula has several inputs. Okay, now we kind of talked about these already, but I just want to give a little bit more understanding as to what these inputs are. First, the stock price, obviously, right? The stock price is going to be the price of the underlying asset, okay? Next, we have the exercise price. This can also be called the strike price. So the exercise price, we are going to use this in our formula to try to figure out, what are we paying for, right? Or what are we going to get in return, excuse me. So the exercise price is going to be the predetermined price that we are going to be able to exercise if we choose the option contract. Next is the risk-free interest rate. We basically use this in order to take the present value of something, right? We bring up all the time in a lot of finance courses that we are going to take the present value of a bunch of cash flows. We're going to discount that. What does that mean? That means we're going to discount the cash flows back to today's dollars. We got to use some kind of rate to discount them by, right? So in this case, we're using the risk-free rate. So next, we're going to use a measure of volatility. Okay, so that's going to be the standard deviation of log returns. That's what's going to measure our volatility, right? So like if you think of two different stocks, right? If you think of one stock that's not, now time out. What does volatile mean? Volatile means that the stock price is going to move very dramatically from its mean, right? The mean of the data of its stock price. It's going to move very high or low away from that mean. If something's not very volatile, that means it's going to move, very consistently with its mean. It's not going to be very far away from it. So, the standard deviation is going to measure volatility. Let's think about this in terms of options. With volatility, what are we actually going to be measuring in terms of options? Well, the idea behind that is that the more volatile a stock, the higher up or the lower down it goes, the more valuable the option is going to be, right? Because with an option, we don't know what's going to happen, right? But if it's got a higher standard deviation or measure of volatility, then that option is going to be a lot more. That option is going to be a lot more valuable because we've got to account for this volatility. So basically, if we look at the formula that has been derived by Black and Scholes, what we are going to find is that we have two components. Okay, I would draw those up there if I could, but we have two components. We've got what are we getting and what are we paying? Okay, so the two components of the Black-Scholes model are basically saying what are we getting, and we're going to subtract out what are we paying. So if we subtract out what we're paying from what we're getting, that is going to be the value of the option. So the next question, the next topic that Black and Scholes in their article, what they talk about is warrants. Now, up to this point, we pretty much just talked about options, right? Options are going to be these things, again, that you are either going to have the right, but not the obligation to either buy or sell a security. Warrants follow that same kind of idea, but I want you to think about it this way. Warrants are going to be issued directly by the corporation, and they are going to have a longer time to maturity, generally a year or longer. Whereas a call option or any kind of option, they're generally going to have like a 9-month maturity. So warrants are going to be longer term. They're going to be issued by a corporation, whereas with a stock or an option, we're actually anybody can sell an option. Anybody can issue an option, right? Granted, they have the ability in order to do that. The model is going to work the same way for warrants as it did for options. So first, we're looking at what am I paying versus what am I getting? Nope, other way around. Excuse me. What am I getting versus what am I paying? We subtract out what you're paying from what you are getting. That is going to be the value of the warrant. So what does all this matter? The idea is that if it's the same kind of concept when we look at stocks, right? If the price of the option is overvalued, we're going to sell it. We're going to go short on it. We're going to do a put option on it because we think the stock price is going to deviate back to the mean and go down. If the option is undervalued, we are then going to go long on it, or we are actually going to buy a call on it because we think that the stock price is again going to deviate back to the mean, and we are actually going to be able to buy we're going to be able to buy an option that's going to appreciate in value. So the last thing I want to talk about is how does this shape future literature and the finance environment in total. So according to Investopedia, Robert C. Merton actually helped write this paper, right? But later that year, he published his own article, The Theory of Rational Option Pricings, in the Bell Journal of Economics and Management Science. And he expanded the mathematical understanding and applications of the model by coining the term Black-Scholes theory of option pricing. So we can see even from the time that it was written up until now, this has been a very popular and very fundamental and foundational method in order to actually continue writing options, what we can actually sell these for, or a warrant, what corporation can actually sell these for. It's been extremely fundamental in the way that we view options and how we can actually price them, so we can see if there's an undervaluation or an overvaluation, and the same goes with warrants. So that is going to wrap up our talk on the Black-Scholes model. Thanks for listening. I appreciate it.